Howdy, Jacob here. Today we're looking at Vital Energy in the oil, gas, consumable fuels industry. Looks like they're an independent energy company engaging in acquisition, exploration, and development of oil. Founded in 2006, 2 billion market cap, way higher enterprise value, 794 million in revenue to almost double 1.5 billion in 2023. Return on invested capital has historically been quite high when it is positive earnings, but you're looking at a very cyclical business that we see as low as negative $222 earnings per share to as high as $46 billion earnings per share. Balance sheet shows 14 million cash on hand with 1.6 billion long-term debt. That's a concern of mine immediately because think about it from a personal perspective. If I have $14,000 in cash, but I have $1.6 million in debt. Obviously, it depends when that debt's due. If that debt is due over the next 30 years in a mortgage and I make $300,000 a year, you're less concerned by that. But if I am, not that, and I have $14,000 cash in hand with $1.6 billion debt and then due in the next 4 years, that's a very big concern unless I produce a hefty amount of free cash flow. So let's look at what that is in relation to cash flow. We do see maybe 300, 400, let's say 300 million average there. That might even be high. Let's say 200 million average there because this is zero, almost offsetting. Yeah, let's say 300. Okay. Sorry, a lot of back and forth. 300 million, 5-year average free cash flow. You're looking at about a little over 5 years to pay that off, but they have very little cash on hand. I'm a bit concerned about that. I think companies should have cash on hand in case those worst case scenarios come in. It might not be the most advantageous and give them the best, most prospective, moves, but it's the same with people. Anything can happen, especially with a cyclical business like this, where you can lose as much as almost $900 million in a year. Yeah, you can make $933 million of free cash flow, but it's just a very volatile business. So I'd like to have more cash on hand than what they currently do. I'm ready to make some assumptions here. I'm very interested in this. Let's see, revenue growth. I don't think there'll be much. Maybe 2% revenue growth, 12 on the P, price to free cash flow. Margins have been very high. So let's do a big range here. Let's do maybe 30 and 40% on the margin side. Shares, they've been increasing those like crazy, and it's not even due to stock-based compensation. They're really just issuing and diluting a lot of shareholders. So with a $2 billion valuation last year, they sent out $161 million in issuance of shares. That is unbelievable. That is absolutely crazy. They're just diluting everybody. And if their stock is cheap, actually, then why would you want to be diluting shares? Because you're basically selling shares that are very cheap. That doesn't make any sense. You'd want to sell shares that are super expensive and then buy back shares that are super cheap. That's what a capital allocator expert would be doing. I didn't do this saying I'm a capital allocator expert, but a great capital allocator would understand that. And a lot of businesses don't actually have people that are really good at capital allocation. It's actually pretty sad. But the share change, they've been issuing shares like crazy. I don't know, maybe 5%. Let's limit it a little bit. Yeah, it looks here decent. Maybe I'm too much revenue growth here. They have from 794 million down to 837 even pre-COVID. So maybe they have grown too much. Maybe we actually see it decline a little bit. And it's a tiny change, but to me, I'm like, it might just be the business that has been as high as it has recently because of inflation and the price of oil and everything going into it. People really wanted to, when the price of oil is very high, people are wanting to take as much oil as possible as a commodity because they can sell it for as much as possible. The cost is fixed, essentially. Obviously, the labor is going to cost more, this, that, the other with inflation, but if oil and gas is up 50% and it just costs 2% more to drill some more or hire some more people, you're going to want to dig as much oil up as possible. And so I think demand has just been very high recently. This is just the type of industry I'm not begging to get into. So I did just dampen the revenue growth and the terminal P and price free cash flow based upon that. And we get to a price that is still a little bit expensive. Again, I made one tiny change. I did 2% and 12p to 0 and 10, but to me, that does seem more appropriate based on the fact that it jumped up quite a bit recently. And I just don't see prospective growth being as great as anything close to what we're seeing today. So I do hope you enjoyed the video. Have a great rest of your day. Thank you.